And today, I'm very pleased that we'll be hearing from each of the MDBs represented here on how they are supporting countries with Article 6. And then, fingers crossed, Vikram will arrive to give us his take on what's going on in climate finance and what are the gaps. So, in terms of the agenda, we'll start with Hari. I think it's 4 a.m. for Hari. So thank you for joining us so early. Who'll tell us about what we're doing at the bank, what are some of the concerns that we're hearing from our clients on this topic. And then Gareth, Jan Willem, and VK will give us a regional perspective on some of these issues. Then we'll move and have a moderated discussion, and like I said, it's a small group, so we'll try to keep it informal. So without further ado, Hari, over to you.
Thank you so much, Hania. Hope you can hear me.
Yeah, we can hear you well.
Yeah, thanks. Good afternoon, everyone. So if you can put my slides up, it would be great. So slides up, I can't see. It's already.
It's opening. Just give us a couple of seconds.
Okay, here you go. Yes. Yeah, good afternoon, everyone. So thank you again for joining this MDB session. I'm going to talk about what the World Bank is doing to support countries and market to participate through different efforts that bring trust, transparency, and finance. Hania talked a little bit already, like what the MDBs are jointly doing, but I'm going to dive into a little bit into what World Bank is doing. Next slide, please. Just to give a context, I'm sure many in the room know already, the World Bank has been managing the results-based and climate funds since we launched the world's first carbon fund more than 20 years ago, the prototype carbon fund. Again, this has been partnership with many of the development partners we have here in the room. We laid the groundwork for international carbon markets under the Kyoto Protocol and became a kind of a market maker in a way with the substantial funds we have under our management, and that we still oversee today. Of the billions we managed, a significant portion, around 1 billion, came from the private sector. And as you see, we have also paid more than 220 million emission reductions in that time. But most importantly, we have provided critical investment and capacity building to dozens of developing countries so that they can access the results-based climate finance we're offering. And under the Paris Agreement, we are all set to do again, which is the culmination of these 2 decades of lessons learned by working with our client countries in the carbon market space. Next slide. This gives an idea about how World Bank support on carbon markets. And if you notice that it follows the entire value chain approach, starting from conceptualizing new ideas that forces the market requirement well in advance, sometimes of course 5 to 10 years well advanced, then market is ready, prototyping and testing those ideas mostly with the World Bank country programs or with interested partners, and then scaling them up mainly through our country support initiatives. Accordingly, if you see on the slides, the initiatives like the Climate Warehouse, the Carbon Market Club, and the Invest for Climate, these all support the conceptualization and prototyping, whereas the Partnership for Market Implementation facility with implementation and then scaling up. So all of these help facilitating the enabling environment at the country and also for the global level to participate in carbon markets. Then the final piece of the value chain is supporting monetization of carbon credits. This is where facilities like Scale comes in and help monetizing through results-based payments and Article 6 transactions. So all of these are structured under new climate umbrella trust funds and are intentionally designed to complement and amplify our core offerings and also our other critical sectoral and climate-focused resources, so that we as an institution are providing a robust toolkit of climate options that our client countries can access. Next slide, please. So before I introduce details about the specific work that we are doing, it is important to also understand the context in which we are operating at the moment. You are all familiar with many things that are listed on the slide, despite no more than 2 decades of experience with carbon markets. So the market is currently facing many headwinds, both on supply side and demand side. Again, in the private sector, which is where the demand comes, issues like greenwashing, how to identify the quality credits, how to develop a robust decarbonization plans that considers different supporting mechanisms, including the use of carbon credits. All of these are slowing down the market activity. At the global level, again, challenges with robust methodologies and supporting infrastructure like MRV, registry systems, country support systems, and arrangements. So to provide clarity to buyers and the capacity of host countries to get prepared for it, or introducing different levels of uncertainty to market players. Next slide. I think this I do not need to overemphasize here, but I think it's very clear from the experience for the last couple of years where countries that are very proactive and advanced, especially with Article 6.2 transactions, they're still unable to make robust decisions and understanding the role of carbon markets to meet their NDC targets, prioritization of sectors or activities that are eligible to participate, what level of policy frameworks one needs to introduce, and how do actually provide a clear guidance to the market that balances the interest of both countries and market players. I think that's one of the biggest challenges that countries are facing. Next slide. This, of course, summarizes what the World Bank is supporting. So on the supply side, if you see through creating standards like FCPF, new methodologies like we're at the early coal decommissioning, country-driven standards like standardized creating framework where the country owns the entire process and also issue the credits, and creating the assets from eligible World Bank operations. And the market infrastructure side, on the transparency integrity, we, as Hani also mentioned, we offer end-to-end open source modular digital infrastructure and helping countries mainly with the registries and the independent standards to connect, for example, with the climate action data test that we launched jointly with the government of Singapore and IITA last year. On monetization, here initiatives like transformative carbon asset facility TCAF already helping monetizing credits from innovative crediting approaches like recently signed emission reduction purchase agreement with Uzbekistan for its energy reform agenda to remove subsidies, and facility like Scale is aiming to support transformative programs covering infrastructure, nature, and policy interventions. In addition to all this, we are also helping countries with structuring innovative business models around carbon revenue flows. Again, here to quote, recently launched emission reduction linked bonds in Vietnam for water purification carbon market transaction. Finally, we are also working with more than 30 countries now, helping on different elements, mainly enabling environment, ranging from strategic development, policies, framework, and needs assessments. What are the processes and procedures that country needs to establish to build their capacity and enhance their readiness to participate in carbon markets? Next slide. This is just to show, again, the different components of the end-to-end digital ecosystem that we are working and helping number of countries that I listed here. And here it provides an enormous opportunity, especially the digital MRV, to support increase the transparency, build trust, and reduce transaction cost. There is, of course, a side event during this COP jointly with EBRD on December 3rd, where we showcase the work on the digital MRV, how a digital MRV of a particular project can directly connect to the registry and then where the issue is set up. And so please attend that one in case you wanted to find more details on the work that we are doing on digital MRV space. Next slide. This again, Hania also briefly touched upon the Climate Market Club, where we bring up like-minded countries that are already engaged in Article 6 activities, and it provides a platform to discuss technical matters to mainly operationalize Article 6. And as you see, 14 countries and 5 organizations as non-primary members. We also developed several what we call as approach papers on different technical elements. And of course, you can all access these papers on the Climate Warehouse website. Next slide. This is, of course, again, a new initiative from the bank to facilitate a dialogue between sellers and buyers and to understand the needs and the issues each face, co-develop potentially solutions that can help scale markets. We are launching what we call as a Carbon Action Forum during this COP. The government of Singapore anchors the forum, and World Bank convenes and then supports the forum. So there is a launch event on December 5th at 11 a.m. Again at the World Bank Pavilion. So please attend if you want to find more details on this one as well. Next, in my final slide. Finally, for us, partnerships are key. We work with several partners on different issues that are mutually interesting, and then so to enhance the impact. There are some examples of our partners at present. So of course I can talk more about each of these in case interested. But I think moving forward, we are stepping up our ambition to scale high integrity, high impact markets, and we want to do this with others. During this COP, our president will announce the World Bank Carbon Markets Engagement Roadmap, which highlights carbon markets as a game changer, and then sets out the World Bank ambition around 3 elements: how to support a robust supply of high integrity credits, how can we leverage large-scale bank-supported programs, and how we can ramp up efforts to show a sound and well-functioning and trusted carbon markets. Thank you for your attention. I think I took a little more than 7 minutes that is allocated, but hope this helped to understand a range of things that the bank is doing at present. Thanks so much for your attention again. Over to you, Hania.
Thank you. Thanks, Hari. So maybe in sum, we've been in the space for a while. We're investing more in the space with the hope of unlocking capital, but it's hard. Capacity building in EMDs is difficult. It's complicated. In addition to the challenges in capacity building, as the slide that Hari put on the infrastructure, there's national level MRV, there are registry systems, project level MRV. So a lot of different pieces to get right, and the approaches that have truly added value were around convening stakeholders in the Climate Market Club and the Digital for Climate. And Hari referenced the Carbon Action Forum that we will launch in a couple of days that's really focused on transaction level challenges. So if a buyer is trying to sell a credit and is really struggling with thinking through how to label the credit or not. So we're really trying to be practical, so to move away from the theoretical and really learn from the approach of the Climate Market Club that we've worked on very closely with our MDB colleagues. So with this, I'll pass on to Gareth.
Project my slides, please. I'm going to jump into Article 6, and in particular Article 6.8. And I'm going to try to focus on some of the opportunities and what we could do to actually leverage some funding around Article 6.8, and give you an example that we're working on at the African Development Bank called the Adaptation Benefits Mechanism. So Hania, in her introduction, talked a little bit about the need to increase global climate finance, so just over 1 trillion now reported by CPI. I used to have it in my slides, and I often show it. I don't have it this time, but you may be familiar with the spaghetti diagram that they have about the flow of finance, and you'll know that there's that grey bit in the middle that shows that the vast majority of money goes to mitigation, and a very small component goes to adaptation. And this is in stark contrast to the commitment that parties made in the Paris Agreement to try to level investments in adaptation and mitigation. And so I think that one way that we could very quickly make progress on increasing climate finance would be if developed country parties would start to make good on their commitment to balance that finance. Now, I think the main reason why they haven't done so is that there are a lack of instruments to apply funding to adaptation in particular. And that's what we're trying to develop with the adaptation benefits mechanism. So let me talk a little bit about Article 6.8 first of all. First of all, let's start at basically what is a non-market approach. Well, of course, the easy answer, well, anything that's not a market approach, but that's not very informative. But we can look at policies and levies and so on, things that don't, well, many different things I think that we could describe as non-market. But I think there's more information or more detail came on the definition of a non-market approach from parties in various submissions. And the main thing that came across was activities that do not result in the transfer of an asset from a developing country to developed countries. So, and obviously that's what you see in carbon trading, where you have all these registries and all this complexity around how you transfer the units out. So if you don't do that, then it would be a non-market approach. Now, why is this interesting? I think, actually, I used to work a lot on carbon trading, but I found Article 6.8 and non-market approaches now to be extremely attractive, and I think there's a lot of opportunities here that we need to become more aware of. First of all, the assets that you create, and assets in inverted commas, under a non-market approach, they don't need to be fungible. Which means you can get away from this complexity around monitoring and reporting such clearly defined units. And you don't need all this registry infrastructure that Harry showed you to control the transfer and so on, because you're not creating assets that are going to be traded and that are for speculation and for trading and transfer. You're just creating units, or we call them adaptation benefits, that are going to be surrendered as evidence of your contribution towards a non-market approach, in our case, towards adaptation. Secondly, one of the things that we see in the carbon markets is this concept of a crediting period, which is the length of time that carbon projects are able to generate emission reductions. And actually, this is a completely arbitrary figure. And it creates huge value for project developers, and it incentivizes them to find projects that pay off very quickly, and then you get a long tail of effectively free revenues just from continuing to generate emission reductions for sale to the market. And Hania, you referred to the grant equivalency of this kind of approach in the carbon markets. I'm not sure that it is grant equivalency, but I don't know enough about it to know for sure. But what I do see is that carbon projects take up a lot of money, and it continues going, and it comes to the project developer, which is very nice. It's profit-making for the project developer, but it's not a good use of scarce climate finance. If you apply it under a non-market approach, where you don't have a crediting period, but instead you have a length of time where you generate revenues long enough to enable the project to become sustainable, then you use much less finance. And we've done some studies to look at comparing, for example, an afforestation project from a carbon point of view and an adaptation non-market-based approach. And it's much more efficient. It's a much more efficient use of climate finance to use it for the project and then stop paying that project once it's completed its task. And the third point is that if you can develop particularly adaptation projects or non-market approaches that don't result in a transfer of mitigation units out of the host country, then you help the host country meet their targets. You help them raise ambition, which of course is something that we want to do. So why don't we see more about Article 6.8? Well, lots of reasons, but I think that first of all, many activities are not recognized and reported as non-market approaches. So I mentioned things like policies and taxes and subsidies and so on. These don't usually make it, or they're not presented as non-market approaches. There's a big focus, of course, on 6.2 and 6.4. And every time I come to this event, every year, I have to edit the agenda to say it's Article 6, so it includes Article 6.8. And Hania, you spoke largely about 6.2 and 6.4 in your introduction, because always this interest is in the carbon markets. But don't worry, I'm not going away. I'll always be raising it. And the last thing that we need really to make more progress on this is governments to realize that they need to step up and create an enabling environment that encourages the corporates and consumers in the developed world to start contributing towards adaptation and not just paying for mitigation. And that's something that they could easily do. They could invite corporates to say, look, you know, you're doing a great job with your mitigation, you're spending all this money on your net zero targets, but we have a commitment to balance investment in adaptation, so let's start looking at what we can do for adaptation. Now, let's move just briefly to the adaptation benefits mechanism. And this is one opportunity to develop a non-market approach under Article 6.8. The context is that in Africa and in the rest of the world as well, but particularly in Africa, we need more adaptation finance. But the main reason why we don't get adaptation finance is that adaptation projects don't give you cash flow. It's very hard to make money out of planting mangroves. And so you can't borrow money as a project developer for an adaptation project because you can't pay it back. And as a result of that, most adaptation projects are grant projects given to the public sector because donors don't like giving grant money to the private sector, and the public sector don't bring entrepreneurial skills, they don't bring innovation, they don't bring risk-taking. So adaptation is not a very exciting and sexy space. So we created an instrument that enables consumers and corporates and donors in the developed world, philanthropies and, as well, to pay for what we call certified adaptation benefits. And that is a cash flow to an adaptation project developer. We follow a project cycle very similar to the clean development mechanism and the voluntary carbon markets. It would be very familiar to you. We have approved methodologies. And in my previous slide, I mentioned that these adaptation benefits are not fungible. That means that they're different for different technologies. So I'm sorry, it's messy, it's complicated. You've got, you know, kilometers of coastline protected. You've got hectares of climate resilient agriculture. You've got households accessing potable water supplies. So, you know, they're complex and messy, but they're defined in these approved methodologies. So there is a scientific process to agree what it is that you're going to deliver. There's a methodology behind that, and you find a buyer who's happy to pay for that. And then when the buyer receives the certified adaptation benefits, the idea is that what they actually get is a code, and you'll go into the interface, you'll use the code to cancel or redeem that adaptation benefit, and you get a package of information that you use to report through the enhanced transparency framework how much money you actually spent on delivering genuine adaptation benefits in the host country. And that's extremely valuable because to be able to report the contribution that you've made to a host country's needs is something that we're going to have to be building capacity to do. And then I think my final point, or second penultimate point, is that project developers, when they get a registered project and a signed purchase agreement, this would then form collateral that would enable them to borrow money from a development bank or a local commercial bank. Of course, that's not happening yet because nobody knows what an adaptation benefit is, but it's where we were with the carbon markets in the early 2000s when the prototype carbon fund kicked off and started signing purchase agreements for certified emission reductions. And surprise, surprise, that is where we are now with the adaptation benefits mechanism. We're trying to create a fund called the African Adaptation Benefit Fund that will do just that. We will have a call for proposals and we will sign purchase agreements for adaptation benefits, and we'll try to kickstart that market and demonstrate to donor governments that there is an instrument that they can point to and encourage the private sector and consumers to start contributing towards adaptation. Thank you very much.
Many questions, and I know you're leaving.
I'm sorry,
soon.
yes, I'm going to have to leave before the event's over. But I'm around for the whole 2 weeks, and our pavilion is just next door, the
FDB
pavilion.
Because I know you have to leave, Gareth. Where's the conversation today? Anything we should look forward to this COP? And then second, are there any pilots? You referenced the fund that you've been thinking about, but are there any project pilots that you can share with? And then what will it take to get this off the ground?
Thank you very much, Hania. Those are all three great questions. Let me just touch on them briefly. So I think the big thing we're hoping for out of this COP is the creation of a database or a website for the Article 6.8 non-market approaches, and we need to get the adaptation benefits mechanism listed there. So some of our champion countries that are supporting us, we hope will put their weight behind that to get it listed. And if we can get it in there, then we're in a much stronger position to go to donors and say, look, African parties are asking for this, so please give us some money to help develop it. We do have sort of a half promise of funding from the US administration. The Treasury put in the 23-24 budget, they put money in for, specifically it says on page 808, to anchor the adaptation benefits mechanism. But as you know, that budget is stuck in the approval process in the US government, and I don't know when it finally comes out whether it'll still be there or not. But that's our big hope, to actually get some money to kickstart the fund. Where we are with pilot projects, we have 2 pilot projects that are underway. One is climate resilient cocoa production in Côte d'Ivoire. So that's basically agroforestry methodology. And the second one is rapidly deployable temporary dams in a housing estate in Lagos to help cope with flooding that comes from 3 different directions, depending on what the event is. And so that's very interesting. They're both developing their methodologies. The projects are actually ongoing already on the ground. They're kind of pilot things. We're just running in parallel. So as soon as we can get the methodologies approved, then we should be able to, hopefully this time next year perhaps, actually have some certified adaptation benefits to show what they are like. We have a methodology panel. Axel Mikalova and Dauda Ndai from the Islamic Development Bank are the 2 co-chairs for that. We have an executive committee and so on doing all their work, and we'll have some more events around here. I think the sort of the last thing that we're trying to do is really fundraise for the African Adaptation Benefit Fund, and we're hoping to work with our partner MDBs. I think they're all waiting to see what progress we make before they jump on board. But I'm confident we'll get there. It's just taking a long time, partly because of I think the big interest in mitigation and the 6264.
Yeah, great. Thanks. So this is a vision to create an adaptation market.
But it's not a market. It's not a market because
it's a non-market.
It's a non-market.
An adaptation non-market.
Yes, exactly. An adaptation non-market.
Thank you. Thank you, Gareth. Jan Willem.
Yeah.
Over to you.
Always hard to speak after Gareth. Gareth, I see this as a 3-step model, which is we get more carbon markets, higher prices, a higher share of proceed, and then we can channel it through the IBM, through resilience.
Except the share of proceeds is 5% or 2%, whereas it should be 50%.
Don't ask too much. The ABM is from an EBRD point of view, it would be a market mechanism. Classified as a non-market mechanism for the purpose of Article 6.8, because we are a market transition bank. Let's say maybe my slides can go up. If I can't, I have no eyes in the back.
You can't see, no.
You tell me. EBRD, as I said, is a market transition bank. We very much promote markets and carbon markets in our region. I don't know where the slides are.
It's a bit cold, isn't it?
Okay, that's the opening slide. So if I press now, yeah. So the graph you see here is where we basically show that the countries of operation the EBRD has in Eastern Europe and Northern Africa are quite carbon intensive if you compare that to the EU average and other regions. There has been, if you look at the sub-regional level, there have been improvements, let's say, over the period, with the exception of Turkey, which kind of increased its carbon intensity of the economy. But all in all means that where there's a high carbon intensity also means that there's ample opportunity to reduce and in a lot of cases very cost effectively. So there's an enormous investment need, and we did some, if you would translate that purely from a mitigation side and then looking at the carbon intensities, and if there would be trading in the region, you would need some 400 million a year in the coming years in order to start to really decarbonize these economies. So carbon pricing is going to be very important to make the difference between a a gray or a black project to a green project. And this is the reason we are promoting various carbon market instruments in the region. So I say next slide to myself now. There are, so we have
I think you went one too far.
oh, I clicked too much. Yeah, I'm now on this one. So we have, as most of the MDBs are doing here, we do policy dialogue and capacity building, but also technical assistance and investments. Now, if I translate that to our carbon market area, then let's say, and I come back to that later, but we do quite a bit of policy dialogue. This is not only kind of providing consultancy services, but actually a dialogue with governments by ourselves, also by our senior management, in order to kind of move the dial in the conversation with the countries. And in fact, the storyline is the more they do on the climate as to their ambition and targets, the more finance we in fact can deploy in the countries, and particularly now all the MDBs also have set to be aligned with the Paris Agreement. We need to have the right narrative and the right policy embedding in the countries. Now, if a country says, yes, I want a carbon price, there are of course various options. So we often do a scoping study to see whether it has to be an emissions trading scheme or a carbon tax or a hybrid system of a carbon tax with emissions trading. All of that is possible, and it's very situational or depending on the country and also their desire how they want to go about it. Now, between then countries, there's of course Article 6 and CORSIA, that's the scheme for aviation. Now, we have seen in the past let's say 1 year, 1.5 years, an enormous interest increase in carbon markets, and this is also because the proximity to the European Union, which now has launched its carbon border adjustment mechanism, and it's really now up to exporting countries to decide whether they impose a carbon price themselves and then keep these proceeds and revenues at their side, or whether they kind of transfer that to the Brussels for further spending it by Brussels. And that phenomenon really helps to accelerate the conversation on carbon pricing in a number of countries. Similar to the World Bank, we had a couple of carbon funds in past, and that led to a lot of interesting experience, particularly on let's say, how to measure carbon reductions, and to a large extent that also informed our climate finance tracking methodologies and greenhouse gas accounting methodologies. So it also now will influence, going forward, a renewed interest in climate outcomes and results. But going forward, we will very much look through providing capacity building first and foremost on domestic carbon pricing, and then see how it can be. Hi, Barbara, come in. Let's say, now I lost my train of thought. So to bring the train back, so domestic carbon pricing, but also the international regulated or compliance markets like Article 6 or let's say regional emissions trading scheme like the EU, for example, has. And then there's of course a role for the voluntary market as well, although that, let's say, we need to have a little bit more oomph on the robustness, etc. Vikram, welcome.
Come on in.
And yeah, we are active in this in a number of countries, as you can see in this slide. So we're working in Ukraine, although everyone knows the situation in Ukraine, of course, at the moment. Turkey, we're working with them on Article 6 and CBAM and VCM support. With the European Union, we try to leverage as much as possible the modernization and innovation funds, and so on. So quite a bit of activity, and yeah, we should further accelerate this, because the lack of a common carbon price is a real hindrance to the deployment of, let's say, finance at scale. We can all pledge to do more climate finance, but if the underlying business models are not adding up, then there's very little to be financed. So that's the whole, and carbon pricing can really help here. So on Kazakhstan, just a couple of snapshots on country support. Are we?
Kazakhstan.
Yeah. So in Kazakhstan, there's already an emissions trading scheme we helped to set up in the very beginning. It's a bit lackluster, to be frank, as to carbon pricing, but we can say the same for other carbon pricing models that have been out there. I remember that the EU ETS at the beginning quickly went up to 35 euros, and then there was a collapse, and then it almost sank to 5 euros, which is about the same as the current carbon price in Kazakhstan. So prices in market mechanisms, they go up. They should be a result of the economic development, but they're also very depending on political decisions. But here we in Kazakhstan, we are helping to provide advice on improving the environment integrity. One of the big things in Kazakhstan to be improved is the market liquidity, but we also are working with them on creating international opportunities, particularly the non-ETS sectors. Then another country up and coming is Uzbekistan. There we have been working on the carbon pricing roadmap. As I said, countries come to us and ask, okay, what should we do? So there's a whole suite of instruments that can be deployed, and so it's really in dialogue finding out what would be a good way to start off in implementing the carbon price. Of course, measuring, let's say, keeping your house in order as to emissions is a first step. So doing the monitoring, reporting, and verification of all the emitting sectors, as well as the greenhouse gas accounting around that. And then you can further design. It depends a bit also on your economic structure, whether a carbon tax would make more sense or an emissions trading scheme. If you have sectors that are fully state-owned and so on, then the prospect of doing an emissions trading scheme might be not that good, because with whom are you trading then? So again, you need various private sector actors really then engaged in an emissions trading scheme, and then you get liquidity and so on. And then there's of course the interaction with Article 6, because the moment that a country exports a part of its carbon budget, then of course that carbon budget can no longer be used by its own sectors, and there's trade-offs there to be made. And an advantage of doing an Article 6 before is that there's money for it, whereas maybe there are not enough domestic savings to create the same money value in the country, and then you can use that to kickstart, for example, the uptake of very modern technology and grow the market. I probably already talked too much, so the last slide is on Turkey. Oh no, it's not the last slide. Whose presentation is this? Oh, okay. Well, in that case, I wanted to talk about Turkey, and I wanted to talk about cooperation with the MDBs, but you already did that, Anja, so I'm going to pass it to you. Thank you.
Okay, yeah, that's okay.
Okay, Gareth, see you.
Very good.
Is Vikram oh, yeah, he's there.
Okay, VK, over to you.
Thank you, Paravi.
think
Yeah,
that's
Vikram
these are
controls.
Vikram's slides.
Yeah? No.
I'm not the only one who has it. This is the first event,
Yeah.
so we're also
Exactly. We're figuring it out. But while we
yeah.
we're on it. Okay.
So it's Thank you. No, sorry.
So Jan,
sorry.
while
So
we
sorry.
get the slides back up, I was just speaking
Yes, yeah.
at an event, and I was talking about voluntary carbon
Yeah, next
markets, and it's a country that really
which direction?
prioritizes ETS systems. And you know, the chair walked out after the session. He was like, "Why do you talk about voluntary carbon markets so much? You know, ETS is the way to go." And I'm curious because you were telling us about the Kazakhstan example and then the Uzbekistan example. But how do you see this, and what kinds of feedback are you getting from countries about the decision between, you know, opting for domestic carbon pricing instruments or prioritizing, you know, market or monetization approaches?
I think different actors or different countries are in different mindsets, and there's still, for example, with some countries, the idea that they can only sell. Yeah, but we're living in a Paris Agreement world, so de facto there needs to be a carbon budget of some sorts per country. So you really need to look at, when you start trading, into the opportunity cost and benefit. People forget the benefit for the economy. So in making that judgment as to whether to sell or buy and so on, countries would need to develop their risk framework, almost like you do as a trading company. Have a unit in the government that basically decides, okay, we can bring some liquidity to the market and create a monetized value, and that can help to accelerate the economy in the right direction. And that type of more sophisticated thinking, I think that it's up to us as MDBs to help to cultivate that. I don't think we should go into countries and say, you can sell 100 million ton at this price, and almost see it as an equivalent to climate finance. This is not pure climate finance. This is a market mechanism, and people need to start acting like it. Yeah.
Okay, great, thank you. I think we have the correct
Finally,
slides back up. Okay.
Yeah. No, Jan Willem said it is very difficult to speak to after Gareth has spoken. So I would say there's no need for anyone to speak after Jan Willem has spoken. So he's taken over the complete landscape of the market opportunities. Fantastic. Thank you, Jan Willem. It's a pleasure to be here with all colleagues from MDBs. It is the first family we belong to. And as Hannah very rightly said right at the beginning, what we are trying to do is to build momentum for the markets. We are trying to co-create the markets once again. The MDB working group has been working on a number of initiatives, building knowledge, building capacity, also building on the experience and expertise that we all bring on the table from the Kyoto Protocol and things like that, creating a carbon market club. So, but we all recognize that carbon markets are not an end by itself at the end of the day. Carbon markets are a conduit to reach somewhere, and that somewhere is scaling up the investments that Hannah, you very rightly mentioned right at the beginning. We are all trying to move from billions to trillions, and we are trying to see how carbon markets can provide that financial incentives for the investors to kind of overcome many of the challenges that are out there to catalyze investments. So this is where ADB also looks. We see that the more than 50% of the GHG emissions come from the countries in Asia and the Pacific, and that also means there's a whole bunch of opportunities. ADB has taken a huge target to enhance its climate finance, $100 billion 2019 to 2030 from our own resources, but at the same time, If we need to unlock those investments, we need to explore all possibilities to help countries to catalyze those investments required in those advanced low carbon technologies, enhancing the climate action. And that's how that's our business connect with carbon markets. Many of you are aware that we have been engaged with carbon markets for a long period of time. We were there in the Kyoto Protocol, and we have always taken a two-pronged strategy. We help countries on the capacity building and technical support side on one side, helping them on both upstream and downstream, creating the policy framework, institutional infrastructure, also helping them create sectoral pipelines and helping individual projects so that they can securitize carbon assets on one side. On the other side, we create carbon funds through which we mobilize carbon finance. Once again, we try to help countries to access carbon finance that can incentivize investments in low carbon technologies. So this is what we have done. A little bit of an introduction that, what we try to do is this is our carbon market program 2.0. As you can see, this is a combination of technical assistance projects and carbon funds. We mobilize carbon finance, we provide technical support to individual projects, we provide capacity building support to the governments, to different institutions, and we provide knowledge support that becomes all the more important as we transition from Kyoto to Paris. This is detailed information on some of the instruments that we have done. I would not like to walk you through the different information, but just to give you a little example, in the Kyoto regime, we established Asia Pacific Carbon Fund in Kyoto Protocol first period. With 7 European government participants, we bought carbon assets on their behalf. We backed it up with Future Carbon Fund under Kyoto Protocol 2 period, which was again mobilizing carbon finance to support advanced low carbon technologies. In 2014, we established Japan Fund for Joint Crediting Mechanism, the only bilateral mechanism initiated by the government of Japan. The idea is to catalyze investments in advanced low carbon technology. GSCM, as most of you are familiar with, is kind of a forerunner for Article 6.2, when countries are trying to work on how to pilot, how to get their head around. In implementing Article 6, JCM is already there, with a number of countries have signed bilateral agreements and a number of projects. Once again, majority of the projects in Asia and the Pacific. So we have a body of knowledge and capacity within Asia and the Pacific, not only from the CDM times, but also from JCM, which makes it much more easier to operationalize Article 6. So even in the Paris regime, we took the advanced charge. We established an Article 6 support facility, which is providing both upstream and downstream support to countries. We are working with a number of countries in Asia and the Pacific, meeting their country-specific requirements. But as countries are trying to make their strategies, there's a whole bunch of transitional confusion. First of all, there was a long negotiation. So countries from Asia and the Pacific had challenges in understanding different technical options. We supported that. And now we have got Article 6 rule book. There's a number of carbon market opportunities are coming up, but countries are still trying to develop their strategies, how to use carbon markets as a part of their broader climate policy architecture. And that's where we are supporting countries to enhance their knowledge and understanding of different options, how they should go about operationalizing their NDCs, and in that context, how to use different carbon pricing instruments and also carbon market opportunities. I think this is very important for countries in Asia and the Pacific. So at this point in time, we are working with a number of countries to help them to develop their national strategies, to operationalize Article 6, developing national frameworks. So 3 broad areas of the article support that we are providing through Article 6 support facility. Number 1, we are helping them to develop policy and these national strategies. The second one is to help them develop their institutional infrastructure to operationalize markets. And very important in the current times is to help countries conduct Article 6 pilots. So we think that conducting pilots will again create a body of knowledge that will help countries to operationalize markets. In parallel to all this, we have been developing some of the knowledge products. We have taken a bit of a thought leadership in Article 6 together with other colleagues from the MDBs. We came up with the decoding Article 6 and something that we are taking forward. We are launching a new knowledge product on national strategies for carbon markets. We realize that the countries have multiple opportunities right now to take advantage of markets. They are voluntary markets, they are compliance market, 6.2, 6.4, and then adjusted market, non-adjusted market, then we have Corsia. So I think countries are trying to wrap their head around how to take advantage of market opportunities. So this is what we are working on, providing on-site support to countries, basically to work out their national strategies, to understand that these different opportunities are not mutually exclusive. They need to make their own combination considering their national circumstances and priorities. This is some information on the Japan Fund for JCM, something that we continue to work on. We are already supporting a number of projects. And finally, as I mentioned earlier, that we operate on a two-pronged strategy and capacity building side. So under the Paris regime, while we establish Article 6 support facility, we have established a new carbon fund that will buy carbon assets under Article 6 to mobilize carbon finance once again to catalyze investments in advanced low carbon technologies. The aim is once again to bring about transformations, but not only to purchase carbon assets for the financing partners, but also to make sure that we contribute to the development of high integrity carbon markets, where we are not just looking at the tons of CO2, but we are also paying enough attention and a price on the sustainable development impacts that are brought about for the local communities and beyond. So I'll stop at this point in time.
Thank you. Thanks, VK. So Vikram, you have a lot of people on this panel and in this room and in our teams that are thinking about carbon markets and Article 6 and unlocking finance. And you were part of the early teams at the bank that was also thinking about these issues years ago, and now you're looking at climate finance more broadly. So very much looking forward to your presentation on climate finance trends today, and also about your views on carbon finance and what role has it been playing, what role do you expect it to play moving forward?
Excellent, thank you. I presume this is on, and if not, this is perfect. So thank you. First, apologies for being late. I thought 2 hours was enough. It's doubly embarrassing that when your boss makes it here before you do, then it is what it is. So thank you for having me. My name is Vikram Wij. I am the advisor for climate finance at Climate Policy Initiative, but for full disclosure, also a recovering development banker. As Hania mentioned, 25 years at the International Finance Corporation, including some at the World Bank. If you're not familiar with CPI, and I think just for context, and I'll go through quickly to try and make up for some time lost by Maini not being here. CPI is a global analysis and advisory organization that has deep expertise in finance and policy. And the idea is work with governments, financial institutions, businesses to help drive economic growth, right? And all while addressing climate change. The group as such is new to carbon markets, and to be quite honest, there were a few of us external advisors while we were at the bank IFC, told them not to get into carbon markets. But I think the whole issue of you cannot avoid. I think VK said it. I'm sure Jean-Willem said it earlier. It's not a panacea, but it definitely needs to be part of the toolkit. And of course, with it needs to be the whole slew of integrity issues, which is sort of why we are involved as CPI. But just for recap, this is the latest from the new version of the flagship report, the Global Landscape of Climate Finance. I'll take 3 minutes to set the stage, then I'll try and hopefully get to your MDB and carbon finance question. So good news, VK, is I think we've hit trillion. So it's for the first time, the average was 1.3 trillion. But that's quite a jump from the sort of previous 2-year report, and definitely compared to, it's nearly a doubling from 4 years ago. But the problem is that trillion is not trillions yet, and I think there is a gap of anywhere from 4 to 6 trillion, depending on whose numbers you believe. The point is, no point optimizing that number. We are far, far, far from goal. This is really, it used to be called the spaghetti chart, Now it's referred to as the Sankey diagram. I guess that's the more technical term for it. But basically, it walks, this is the recap of where that $1.3 trillion essentially came from on the left. Extreme right is where it went. So effectively, the different providers of the money on the left, the different sectors where the money made it to the right, and then the intermediation in the middle, effectively. I mean, I'm oversimplifying it, but and this is, and since I referred to the boss, I should mention Barbara Buchner's in the audience. She is the global managing director for CPI, and she started this 10 years ago, so I hope I'm doing it justice. Point is, a couple of quick points, getting to MDB world. The biggest chunk was East Asia Pacific, but if you ignore China, I mean, and of course, even bigger than Western Europe and North America, but if you ignore China and if you ignore Europe and North America, and if you just looked at LDCs and emerging markets at large, it's less than 20%. It's like 16% of global climate finance tracked, public and private combined, that's getting there. So since we are in that world, this is clearly a gap that is going to be huge. So we'll stop here. I'll sort of leave it in this chart while I talk through linkage. So coming back to carbon markets then, we all agree it's not a panacea. We all agree that it needs to play a role. We can talk more about integrity, but the point is, if we are going to help our client countries or the developing countries, meaning the MDB client countries at large, the MDBs have a huge role to play in the context of carbon markets, but also in terms of ensuring that the money is available for the transition. If you take the energy sector itself, the demands on trying to get the conversion, the accelerated retirement of coal, we can talk a little bit about that later, or just the exit from fossil fuels is going to take a huge amount of money. So one of the things, whatever the results-based climate finance it may be in the form of Article 6, in the form of other sort of monetization, voluntary markets, I think the depth of the credibility, the financial policy credibility, and the depth of the strength of balance sheets that MDBs have become a huge asset to trying to help countries do something with it. And Vike, you mentioned, and there are good examples from the World Bank in the billions of the various funds that are available to pay for carbon credits. But either through direct lending, or more importantly, I think through new structures that mobilize private capital. And I'm not talking about private capital to buy the carbon credits as much as I'm talking about mobilizing private capital to fund the projects that will ultimately generate carbon credits. We know, at least at the time I was in the MDBs, getting advance payments from buyers is very difficult. That's not their job. If Sweden wants to, and I pick Sweden, or pick any country that is an Article 6 buyer, is going to commit to buying credits from a developing country, it'll pay on delivery. I mean, that should be their role. But the countries have to mobilize that capital. And I think the private sector can be leveraged. You have to establish financial structures that could actually securitize these future flows so that they can be paid back when the revenue is there. You have to help address the risks in the market. One of the biggest issues is the delivery risk to the carbon buyer, because if that credits don't get delivered, they don't get paid. If they don't get paid, the private sector doesn't get paid back. Our friend Yasser is here. MEGA, for example, I mean, at IFC we did a delivery guarantee at a project level. I think you need a product that can do that at the sovereign level, because you are going to have to de-risk for the lenders, which hopefully are beyond the MDBs, these flows. And of course, I think Vike mentioned, and earlier may have been talked about, I missed Garrett's presentation, but the whole issue of creating pricing consistency in the market, either through collars or some structure that assures a certain level of floor price that is both substantial as well as available to be securitized. Yes, we can leave upside for the private sector that wants to help trade or governments that want to tap into markets later. But there are these, I think there are these three things I would say that the MDBs can do. In addition, of course, to all the technical assistance and capacity building that they're doing to get these countries ready for Art 6. But let's not lose sight that Article 6 is a means to, or any carbon market ultimately is a means to an end, and that is to hopefully effect the, particularly the just version, or the energy transition, including the just version of it. I'll stop here, and sorry if I rushed through some of that, but happy to engage in discussion. Thank you.
Thanks, Vikram. Maybe a quick follow-up question. Of this chart here, is any of this results-based climate finance?
No, I don't think we track that. That's why.
Because it's very small in any case today.
It's any case, it's very small.
Yeah.
But look, the voluntary carbon markets themselves are what, $2 billion right now. That's doubled since there. It wouldn't even be a angel hair past on that chart, so to speak. But you have an intervention. Your mic's on, no? You have a mic.
I really forgot that. But just to add, okay, the voluntary carbon market, let's assume it's 2 billion. If you look at the grant equivalents of the climate finance that is out there, which, as you know, is mainly concessional, zero interest type of loans, then the VCM is almost as big as the global climate funds. Yeah.
From a grant equivalent perspective.
From a grant equivalent, because it's a real transfer of
so
funds to
I think to Hania's point,
country.
this is everything. This is commercial, this is concessional, this is MDB money, this is public, private, domestic flows, everything that's tagged as climate finance. So yeah. I don't think we have a version that does the grant equivalent of all of that, because a lot of it is commercial. So the grant equivalent of the commercial would be zero. The point, though, while that comparison is valid, Jan Willem, I just sort of counter that by saying, at the end of the day, it's the money flows that matter. And if we are going to sort of scale up, then the carbon markets are effectively a promise to do something, pay for something in the future. Question is, how do you bridge to that future? That was the point I was trying to make. But point well taken on the equivalence.
So I want to leave a few minutes for Q&A, but Hari, I want to bring you in just to build on, Vikram, your point around mitigating some of the risks of carbon markets. So Hari, and we'll take advantage of Yasser being here, and we'll ask you to jump in as well. But can you tell us about some of the thinking that we're doing around mitigating some of the risks in carbon markets?
Yeah, thanks, Hania. I think, Asar, good to know that Asar is in the room. So one of the biggest risks, I think, especially in the Article 6 markets that we're all aware is the issue related to the corresponding adjustment. And I'm sure there will be a huge debate even during the COP about the revocation of those authorizations and what implications it will have on the market. I think this is one of the major risks I think the buyers in the market will face in the context of where countries are still struggling to establish necessary policy frameworks and then clear guidance on when to authorize and when not to authorize and what the implications it will have. In that context, of course, I think there are some encouraging examples recently. Of course, 3 countries already authorizing, and then Rwanda, first country authorizing the private sector-led transaction for doing corresponding adjustment. But this is going to be the huge issue for them. I think what MIGA is trying to do right now, building on the experience during the CDM days, I think they are exploring the role what role actually it play in the next generation of carbon markets. It's because the Paris Agreement is the bottom-up framework, especially, and it gives great flexibility for innovative approaches. But at the same time, it also brings risks, and then of course for us, it also offers an opportunity to strengthen the complementary of relevant guarantee products to encourage broader participation. So the use of, for example, MEGA's political risk insurance products, I think that could help build confidence among market actors. In case of compliance markets under Article 6, the use of MEGA guarantees could help these accounting adjustments to ensure that there is no double counting of carbon credits. A final point is, of course, key benefits of MEGA's products is to reduce the likelihood of these risky events transpiring through strong dialogue with the clients and risk mitigation measures. So in this context, I would also emphasize that the government engage is very essential for developing any such major risk mitigation measures so that there will be credible and transparent carbon markets globally. We are, of course, working closely as a World Bank group with MEGA in order to come up with these instruments and these risk mitigation measures that hopefully many countries and then buyers could utilize in the future. So I don't know if Asar has anything to add further and clarify anything for this. Thanks.
Thank you, and thanks for Grim and Anya. So I think you've captured it. I think MEGA as a political risk insurance, one of the things that we are looking at is how can we bridge the risk between the buyers and the sellers and make sure that if the sellers have concerns around these issues, what can we do? So we have worked on a term sheet with the private sector and the public sector to see how our breach of contract cover can be extended to letters of authorization and what is needed for that regard so that we can cover these as part of our guarantees. So this is something that we are working on along with our colleagues in the bank, and I think we're hoping that by next COP we would have something that we could deliver and showcase.
Yeah. So this is really mitigating the risk of a letter of authorization not being issued.
Or being honored.
Or being honored.
Yes, but my only request would be you need to push that. That's the political risk part. But there is a financial risk associated with it also, where the performance risk, let me put it that way, not a financial, right? Whether the country will actually deliver the credit.
And I think this is the risk that's a much harder one to price and to mitigate, but this is actually the risk that will allow you to mobilize this ex ante flow. But this is where, what I was thinking as you were speaking about, it gives me pause when people talk about carbon markets being what's going to mobilize private sector. It gives me pause because I think what's going to mobilize private sector is everything that we all do in our business. The budget support, the enabling environment. Carbon markets, maybe a cherry on top, but I don't know that that's what's really going to trigger these massive flows. And it's for this reason, which is MEGA ain't going to take the delivery risk on, some of our large energy access programs. For instance, right now we have a $15 billion program with a substantial tranche. I don't know that MEGA or any other insurance firm would mitigate that. So that's I think the harder nut to crack.
Yeah, agreed. But can I respond to that a minute? If you look at large programs, right? Let's not just say the World Bank's energy sector program, but there are these, there's the ETA, there are all these other big, that's the Energy Transition Accelerator, for example. There are these, and building on the JET-Ps that are already there. These are country-level programs. Countries are committing to this, right? If a country commits to decarbonize its energy sector in exchange for pre-committed offtake at scales, and we are talking hundreds of billions here, right? We are talking about in the next 10 years, on average, large countries like Indonesia, South Africa, all of them depend, again, it's like perhaps 200, 300, 400 million tons each. At a reasonable price, that's a lot of money. They are going to do that. So there are a couple of different ways of trying to get around it, I think, and I'm just leaving it as food for thought. One is, if the country is committed, can that somehow be translated into a MEGA-type cover on commitment or non-payment? Can it be? And not obligation, exactly. And it's a, so now it's a investment, it's an obligation to deliver, and so there's an indirect way of perhaps getting to that, right? The other thing I think is, and this may not, that helps in taking it off balance sheet for countries, but there's also the possibility of perhaps creating a rolling program of transition bonds where the country issues bonds that are paid back from revenues from carbon markets in the future. We did it at IFC as a forest bond, where only the coupon was payable by forestry credit, but nothing stops you from paying the principal back with carbon credits too. Now it once again becomes a sovereign obligation to repay the investors. So there are, I know it's a little sort of convoluted, but you're absolutely right. Swiss Re, I mean, the big insurers and reinsurers are not going to go into the act, and that's why I think I bring it to this panel as a potential MDB solution.
And this is very much the approach that we're taking at the bank, and you'll hear my bosses talk more about it over the next couple of days around jurisdictional approaches and really looking at our portfolio, identifying the pipeline of some of the larger engagements, whether energy transition, energy access, land-based uses, and building on our track record with the forestry, the FCPF, the Forest Carbon Partnership Facility, where we developed a jurisdictional approach and a standard for sectoral approaches. And I think that's where you get the scale. That's where you could potentially get these types of buyer clubs to give commitments. With our energy access program, we're talking to ACME, with our Africa East program, with the ETA as well. So that's a little bit the angle that we're taking, is to be selective, not to say we want to do it all, but to look at a handful of large-scale projects to try to get that buyer appetite to come in, and then we'll try to get MIGA to structure delivery risk instruments.
I think that basically two modalities here. So there's one model where Yasser is underwriting the carbon transaction of some sort with some political risk. Of course, the MDBs can be counterparts in between these transactions themselves, and we kind of self-assured, in short, in this regard, because if a country makes a commitment, then that will be treated under the legal regime. So I think then the private sector leveraging is more, okay, that value will come to the country and needs finance, and you have all these projects in the agricultural sphere or in the energy sphere that needs private sector financing, but that will then flow because hard currency comes in, and also the terms of the finance are more attractive than for the private sector. So I think that will be probably an interim phase until you kind of get a new norm and establish on this type of transfers, and there's no repealing of contracts, etc. And at the moment that happened, but that we're talking about 10 years or so for risk committees in the private sector to accept that as a credit risk, or even longer. Yeah.
Yeah. Okay. There is one modality that we have, at ADB, we have implemented very successfully, and that is much appreciated, is to enter into long-term purchase agreement on a fixed price, and also having the possibility to provide upfront finance. That because carbon market mechanisms usually are performance-based mechanisms, and again it depends on a number of things, including the price. So all the transformational change that we want to catalyze is very difficult if the project investors are not sure what kind of, or what is the volume of carbon asset they will get and what the price they will be able to get, and therefore what volume of carbon finance they'll be able to mobilize. So in that sense, if that is something MDBs can really implement, and we have kind of tried that through our previous carbon funds, and this is what we are going to with our new carbon fund as well, is to enter into long-term contracts, purchasing a volume of credits that are very safe to purchase, which is not going to put the selling countries under undue pressure, also maintaining the integrity of the markets, but at the same time providing a fixed price so that the project investors are assured of the volume of carbon finance they'll be able to get. And if that carbon finance can be provided to them up front, they can use that money to overcome some of the capex challenges that they have. That's the time where, you know, the carbon finance can move away from the cash flow mechanism that we usually have, and that can be used as an investment element and reduce the capital investments required by the project investor. So this is something that can be kind of scaled up. Of course, that would require that some of the buying countries are able to put their money. But I think in the current context, when all the buying countries would also have NDC targets and a reasonably good idea of what their volumes they would require and what their cost of compliance would be. So I think some pricing mechanism can be worked around. So this is one element.
I see you holding the mic very closely.
No.
Any questions from the audience? Feedback, yeah.
Thank you. My name is Anna Krzyżanowska. I work for the European Commission. I'm an advisor for Access to Finance for Innovation. Well, obviously, innovation brings an additional element of complexity into what is already a very complex environment you're trying to work with. So my question is, we've been talking about mostly, correct if I'm wrong, but mostly publicly underpinned or supported mechanisms enabled by donor funds, very often by public money. In Glasgow, in great fanfare, we've announced First Movers Coalition. I wanted to ask, how do you see the mobilization of industry, not only for buying carbon credits, but also buying products and services and solutions of sustainable nature in the countries, and thus supporting the task that you have?
Yeah, maybe I start. I think you already see this phenomenon in Europe with the hydrogen bank, and the concept there is to create a market through contract for differences. So you could imagine a situation where a contract for difference price is underwritten by an Article 6 transaction as a funding mechanism. So that could be a way to link that up. Of course, it would be good if the whole contract for differences from the European Union would also open up to third countries. It's in the working, because you know that the marginal cost for green hydrogen production in the neighborhood are quite attractive as well, but still need, compared to natural gas, quite a big margin to reduce. Yeah. But so this type of mechanisms to trigger. So innovation is you need many things for innovation to work and markets to pick up. But and that's what I think what you're trying to say on the jurisdictional approaches. It's really about creating the market conditions at the scale that it is becoming interesting for industry to come in, to invest in their trade arm in the country, the servicing, all of that is costing money. They will not come in if it is a very small market in the beginning. So if you can build a prospect of a couple of billion to be made, then industry will start to invest.
Yeah. And maybe just one point to add, but maybe focusing on carbon. I think you're absolutely right that a lot of the carbon funds business to date has been primed by donor funding. I mean, it's the donor funds that are giving this floor price that gives certainty to projects that 10 to 20% of the carbon will actually be paid for. And I think here the interesting question is, can we, envision a scenario where you have the private sector providing that capitalization? And I think the answer is, I hope the answer is yes, and I hope we're heading in that direction. I think on the ITSMO side, there is potential on 6.2, and on the voluntary side, I mean, I think, you know, corporates, at least the corporates that we've been talking to, I mean, they're craving certainty, and, you know, VCMI just came out with its Scope 3 flexibility, I forget it has a long name, but something around 50% of their Scope 3 emissions can be mitigated via offsets, and I think that could, that's something there. Then you can have a conversation with, you know, corporations that actually want to buy carbon credits to offset Scope 3. Now, at what price? We probably, who knows, but, you know, big question how much such credits can fetch. But I think more certainty around use claims could really help us mobilize private capital towards carbon. And I think there are good developments, still ways to go, but good developments on supply and demand side and integrity that can potentially get us there. And, you know, maybe speaking of actual concrete projects in our portfolio, maybe, you know, testing these concepts in actual projects that we're working on is one, you know, one idea that we can, you know, think about in the Climate Market Club and the Carbon Action Forum is, you know, piloting approaches, because these are big problems to fix. And I think, you know, our approach, including through structuring capital markets instruments like the Vietnam carbon-linked bond that the bank issued in February, it was really about, I mean, let's start small, let's pilot, and then scale. With that, I think we're right on time. Thank you very much.